Welcome to Catalyst. I'm Madison Mills. 30 minutes into the U.S. trading day. Let's get you the three catalysts we're watching this hour. First up, we'll break down the market action following the latest jobs report, which surprised to the upside. Plus, we'll discuss what Warren Buffett might do with that record cash pile ahead of the Berkshire shareholders meeting, and a check-in on the U.S.-China trade war as China signals it's ready to talk. What does that mean for the shipping industry? Half an hour into the start of U.S. trading, let's get a check on the major averages here. Taking a look at gains across the board. You've got your S&P holding above that 5650 level. If we do close where we are at right now, the S&P will have erased all of the post-Liberation Day losses. That was on April 2nd when those so-called reciprocal tariffs on dozens of countries were announced by the Trump administration. You also got your tech-heavy NASDAQ up about 0.8% at the moment. Let's take a look at the bond market, though, that curve steepener. Actually, we're going to take a look in at Apple at the moment because it was interesting to see the moves on Apple off the back of its earnings. You can see that company still moving to the downside here. It's down about 4.5%. I also want to take a look at Amazon. It's been interesting to see Amazon flipping between red and green this morning, though at the moment it is down a little over 1%. Well, I want to bring in Ed Al-Husseini to join me for the hour. He's a global rate strategist at Columbia Threadneedle. Prior to Columbia, he worked on resolving financial crises as an economist at the World Bank and the IMF. Ed, it's great to have you in studio. Thank you for making the time. So one thing I'm eager to talk to you about is the fact that we are now a month out from that so-called Liberation Day when all of those tariffs were announced. There were so many deals teased out. We're so close with India. We're so close with Japan, but we have yet to see a single deal. Where are we heading? Are we getting deals?
Yeah, I mean, it's been incredible how quickly that news tends to decay in markets. Markets first absorbed that negative shock coming from tariffs. We went down in terms of equities. We broadened out credit spreads. And progressively, as bad data did not crystallize so far this month, we've managed to pull back up. And so, look, on the trade policy front, not a lot has changed. But incrementally, we're not crystallizing some of the downside risks, and markets are starting to sniff that out.
Yeah, and talk to me about that, because the S&P 500 is on track to recoup all of the post-April 2nd losses. Is the market ignoring the weakness that is still there because of tariff policy, or is there actually some optimism that we're just not making enough time to talk about?
Yeah, I mean, look, I think on the optimistic front, there's a fair amount of growth momentum that carried over from last year. We've had a fantastic growth story over the past couple of years. Some of that momentum is carried over into the first quarter, no doubt. The labor market this morning has shown, fantastic signs of strength. Again, if we just look back over the course of the last 4 months, the labor market has been in pretty decent shape. Earnings, it's a very mixed picture. Obviously, earnings guidance at this stage is going to be very murky. But in terms of numbers that have come through so far this year, they're quite good. And so again, markets are just not finding enough negativity to latch onto in terms of risk assets right now.
Well, let's take a look at some of the so-called safe havens. I want to talk to you about the bond market because we're seeing just a bit of a curve steepener going on over the course of this morning here. What does that tell you about how bond investors are thinking about any potential growth scare or economic weakness to come?
Yeah, so I think the cleanest story in rates markets has been the downgrade to growth expectations in the course of the first quarter.
Yeah.
I think consensus went down from maybe about 2.5 to 1.5, perhaps a shade lower. And so that's allowed the bond market to price in a much more aggressive Fed easing cycle, about 100 basis points this year. And so now that's being reassessed. Does the Fed need to execute that? Probably not with this data set, at least not at this stage.
All right, really great overview. Ed, you're going to join us for the whole hour. Lucky for us to give us your insights. So thank you so much for being here. I do want to move forward, though, because President Trump is renewing his calls for the Fed to cut rates this morning following the stronger than expected jobs report. So with a strong labor market and inflation above the Fed's 2% target, how will the central bank balance its dual mandate? Joining us now, Brett Ryan, Deutsche Bank's senior U.S. economist, and still with me is Ed Al-Husseini of Columbia Threadneedle. Great to have you on here this morning. Brett, talk to me about this idea that the Federal Reserve is going to be able to cut rates in June. We're now seeing the bets on a June Fed rate cut have evaporated in terms of what the market is pricing in. To what extent do you believe that we are going to see a rate cut as soon as this summer, according to what the president is saying he wishes on Truth Social this morning?
Yeah, thank you for having me on the program. And I would agree. We don't have a rate cut this summer. We don't have a rate cut in June. We have one rate cut in December of this year. So The data certainly today do not point to an imminent rate cut. And the reality is, with the inflation outlook where it is, and the Fed very concerned about the inflation outlook in the context of being above target over the previous 4, almost 5 years, they're going to be focused on that first and foremost. And with the labor market still holding in, there's no reason to cut whatsoever.
Yeah, and what happens if the labor market does start to roll over? We continue to hear people say, well, that's just pre-tariff data. We need to see the post-tariff data. If we do see the labor market roll over, do you think the Fed would potentially look at that part of their dual mandate more than the inflation part?
So Fed Chair Powell's April 16th speech, I think I would point to is very informative in that view. The first, Chair Powell said, we can't have a strong, sustained labor market without price stability first. That kind of gives you a hint on what their focus is.
Right.
The second thing, the Fed Chair Powell would say, we'd look at how far away we are from our employment and from our inflation goals, and over what time frame we could get back to those, and that's how we'd set policy appropriately. In theory, you're going to be significantly further away from your inflation goals by, let's call it, the middle of the summer of this year, if tariffs go into effect as expected. And the employment goal, that remains to be seen. If there's a sharp decline in the labor market, 2 to 3 months of large negative prints with corroborating data in jobless claims and rising unemployment rates, sure, they're going to cut. They're not going to be immune to it. Mm-hmm. But relative to the 2018-2019 period, where the Fed could be preemptive in addressing downside risks to the economy, they can't do that this time because of the inflation backdrop and where inflation is expected to be going. So, they're skating toward the puck on inflation, and not necessarily skating toward the puck when it comes to the labor market at this point.
And Brett, my guest host Ed Al-Husseini has a question for you.
Brett, thanks so much. Brett, when you look at the wage data coming out of this sprint and the wage data we got earlier this week in the employment cost index, what does that tell you about the inflation outlook? How should the Fed interpret it so far?
Yeah, so I think it's a great question, and the wage data are telling the Fed they were on the right track prior to the tariff announcements and the volatility there. The labor market seems to be in pretty decent balance. We have a situation in where you have low demand, low hiring, but also very low firing, and that's what's keeping payroll prints positive each month. But wages at 3.8% year over year, that's close to in line with where the Fed sees that consistent with this 2% target. Same thing with the ongoing progress in the employment cost index, which is their more preferred measure of looking at things. And the snapshot that you get from the latest wage data is that the labor market is not a source of inflationary pressures, and that is an important point as they approach this going in.
Yeah, it's a fantastic backdrop. Let's do a little bit of time travel. If you look ahead through the end of this year, paint us a positive and upside scenario for the labor market. What could that look like? Yeah,
sure. An upside scenario for the labor market, I think, involves some quick trade deals that, kind of take away that negative downside risk to disruptions to supply chains, particularly with the auto sector. I think if we could get the auto tariffs out of the way with some trade deals, I think that would be certainly a relief. And so, it could very well be the case where it's more of the same. I like to say a point forecast right now is, you don't want to be wedded to a point forecast. It's the range of outcomes and scenario analysis. And I could easily see, our baseline, our baseline forecast is for growth of about 0.3% over the back half of the year annualized. I could easily see 1.5% if, we get some quick trade resolutions to these trade issues, and we get a quick fiscal boost to kind of offset some of the tariffs with the upcoming tax bill. So I think that's the other thing I think it's important to keep in mind here is, just as Powell said on April 16th, we want to see what the totality of the administration's new policies look like and what their impact is on on employment, labor, growth, et cetera. And the tax bill is the next big thing. And that's going, we're expecting somewhat of an offset there in terms of the drag from trade.
Yeah.
So how those two kind of balance out, the boost you get from the tax bill versus the drag you get from trade, that's going to be important in terms of how the back half of this year goes.
The totality of the policy, totality of the data, you got to see it all, Brett. Thank you so much for joining us. Appreciate it.
Thanks.
Well, tariff uncertainty has fueled recession fears, and this week's Q1 GDP reading of negative growth put the possibility into focus. So what actually defines a recession? Here to break it down, our senior reporter, Ali Canal. Hey, Ali.
Hey, Maddie. Yes, the common held belief is that 2 quarters of negative GDP growth signals a recession, but that's not always the case. The official call actually belongs to the National Bureau of Economic Research, otherwise known as the NBER. This is a non-government entity tasked with identifying recessions. But here's the catch. They don't predict them. Rather, their job is to confirm them following months and months of quote-unquote hard and often revised economic data. That means we often don't know we're in a recession until it's already underway or sometimes even over. But here's what the NBER looks at to make the call, because it's more than just GDP. They analyze a wide range of indicators, including employment, personal income, industrial production, and real business sales. And they also weigh the 3 Ds: depth, diffusion, and duration. Take the COVID recession, for example. It only lasted 2 months, but it was the deepest and most widespread drop in modern history, particularly when it comes to the unemployment rate. That was enough for the NBER to call it, even though it was historically short. On the flip side, the U.S. economy technically avoided a recession in 2022, and this came despite 2 negative quarters of GDP, along with a dramatic drop in the stock market. But the rest of the data didn't back that up. In fact, one of those GDP readings was later revised slightly upward, meaning it was no longer negative, and unemployment didn't budge. Instead, it fell, so job growth stayed strong. That's why economists caution against fixating on GDP alone. It's also a good reminder that not every market meltdown equals a recession. That's actually not something that NBER even considers in their decision. Economists told me that if you want to focus on just one indicator, the unemployment rate might be your best bet, but even that isn't foolproof. Bottom line, we may be feeling a little nervous, but officially we're not in a recession yet, and if one is coming, we likely won't know until it's already behind us. Maddie?
All right, Ali, thank you so much. Appreciate it. We're going to have all your markets action ahead here on Yahoo Finance, so stick around. You're watching Catalyst.
We've all heard the saying, sell in May and go away. But how well does it actually work for investors? I'm Jared Blickery, host of Stocks in Translation. Now, sell in May is older than you think, like 1694 old. London traders first coined it, timing their market exits in the summer, then buying again just after the famous St. Leger horse race. And that was in September, in the middle of the month. Now, if we fast forward to 1986, our friend of the show, Jeff Hirsch, he put that phrase front and center in his Stock Trader's Almanac. And nowadays, Americans mostly think it's Memorial Day in early May through Labor Day in early September. But the big question is, does this old saying, does it still hold true? So let's crunch nearly a century of numbers. From 1928, we split each year into 3 equal parts. And it turns out that May through August was pretty strong until about 1960. But then things flipped. Between 1960 and 1987, the early days of modern Wall Street, it really paid to step away from the summer. Since then, though, not exactly. Summers have been positive, just not as strong as the rest of the year. So let's keep this simple and imagine if you invested $1,000 in 1960 in 2 different ways. If you'd follow sell in May, and that's the white line you're looking at, you were actually winning in the 1960s and 70s. But then things changed with the big crash in 1987. And after that, the fully invested strategy in green, it pulled ahead. Sitting tight in these months has been a winning strategy, at least on balance since then. So finally, let's take one more look at the month-by-month gains and losses since 1988. This is a seasonality chart, and if you notice, you can see August and September, those 2 bars are poking below 0. They consistently drag. So if you wanted to steer away from potential trouble, these 2 months might be it, but not the entire summer. So bottom line, sell in May made sense once upon a time, and today, you're probably better off staying invested, and maybe just keeping an eye out for potential trouble around the new school year. I'm Jared Blickery. Tune into Stocks in Translation for more market decoding deep dives, new episodes on Tuesdays and Thursdays on Yahoo Finance's website or wherever you find your podcasts.
All right, Jared, thanks so much. It's now time for some of today's trending tickers this morning. Let's take a look at what we are looking at here. We're going to pull up a couple of our trending tickers, but first, I'm actually going to start on the major averages. You're taking a look at gains across the Dow Jones, the S&P 500, as well as your tech-heavy NASDAQ. You've got your S&P 500 up 1.2%. Your tech-heavy NASDAQ is also up 1.2%. It's interesting to continue to see the tech-heavy NASDAQ moving up, given the confusion around the results that we got from Apple and Amazon. You can see on your screen, Amazon down just about 0.2% this morning. Apple continuing to move to the downside, though I think Nvidia's move to the upside is contributing a bit to that tech-heavy NASDAQ gain this morning. Coming up, we're getting a read on the consumer and demand and how tariff impact could impact the retail space. The CEO of Brooks running live from the Berkshire Hathaway shareholder meeting. That's next. Berkshire Hathaway's annual shareholder meeting kicking off this weekend. Top of mind for investors will be Warren Buffett's succession plans as the Oracle of Omaha nears his 95th birthday. So who could take over CEO of one of the world's most influential companies? Well, his name is Greg Abel, and his designation as the next CEO of Berkshire was accidentally announced by Charlie Munger several years ago at the shareholder meeting. But who is this guy? The Canadian businessman has been with Berkshire for 25 years following the company's acquisition of Mid-American Energy, where he served as CEO. He currently chairs Berkshire's Energy and has been instrumental in managing the company's diverse portfolio of non-insurance businesses. Buffett has expressed full confidence in Abel's ability to lead, stating he is 100% comfortable with him as the future CEO. Abel's leadership is expected to preserve Berkshire Hathaway's culture and conservative financial approach, ensuring continuity in the company's operations and strategy. Well, coming up, the Port of Los Angeles expecting a 35% drop in shipping volume next week. The executive director joins me to discuss. That's next. It's now time for some of today's trending tickers. We are watching Take-Two, Wendy's, and Airbnb all on the move this morning. First up, let's take a look at Take-Two Interactive sinking after it pushed back the release of Grand Theft Auto 6 to next year, giving the team more time to finish what's expected to be one of the most lucrative video games ever. The title, which has already missed multiple deadlines, would likely have been the biggest release of 2025. Now it won't hit the market until May 26th of 2026. Wendy's, meantime, lowering its sales outlook for this year, the latest restaurant chain taking a hit from consumers worried about a shaky economy. Global system-wide sales are set to decline as much as 2%, while the company had forecast in March an increase as large as 3%. The cut follows a steeper than expected sales drop for established restaurants in the first quarter, mostly due to weakness in the U.S., driven by slide in visits. And finally, Airbnb issuing a weak outlook for the second quarter, citing economic uncertainties for softer travel demand in the U.S. The company's growth for nights and experiences booked is expected to moderate from the 7.9% achieved in the first quarter, falling short of Wall Street's 8.6% projection. Airbnb, which of course specializes in shared homes and vacation rentals, also said it will share more details about its push beyond accommodations into new businesses at an event on May 13th. And you can scan the QR code below to track the best and worst performing stocks with Yahoo Finance's trending tickers page. Well, President Trump's preliminary 2026 federal budget would increase defense spending by 13% for a total just over $1 trillion. The president's budget proposal would also cut over 20% from all federal non-defense spending, representing over $160 billion. Trump's suggesting cuts to the Department of Energy, the NIH, and the Environmental Protection Agency, among others, but staying away from any proposed cuts to Medicaid, Medicare, or Social Security. Those measures falling to Congress coming forward here. Joining us now, Nebraska Congressman Mike Flood. Representative, it's great to speak with you. I do want to start on that skinny budget, including over 20% cuts to domestic spending. How are you thinking about your own budget needs and how these cuts to funding could impact both your own policies and your constituents?
Well, I tell you what, we're $36 trillion in debt, on our way to $37 trillion in debt, and this is a national security issue. So we do have to cut spending. I think as a Republican conference, we have been talking about this for the last 5 years. What do we need to do? How are we going to get there? This reconciliation package is merely the first step. I think you're going to see in our budget that we deliver later this year, you're going to see continued reductions in spending. And ultimately, if we grow the economy by passing the tax cuts and we slow and reduce spending on the other side, that's the only way that we bend the arc on what is a national security issue, our $36 trillion debt.
You mentioned concerns about the deficit, and of course, the Trump administration has touted the idea that tariffs could be a way to start to tackle that deficit. But the administration has also said that there are going to be deals made so that the tariffs are not as severe and have as severe of an impact on companies. So which one is it? Are tariffs a measure meant to help tackle the deficit, or are we going to see deals that don't make them as significant of a revenue driver?
Well, look at what happened in the first Trump administration. President Trump cut deals with Canada, Mexico, China. Pair that with the tax cuts that were delivered in 2017, and America saw seismic growth, obviously interrupted with the spending that occurred over the COVID virus. We have the same opportunity to do that here. I'm actually confident that President Trump is going to do the same thing he did in the first administration, and we're going to have fair trade, free trade with a lot of countries around the world that will return benefits to Nebraska farmers and ranchers, to folks in Pennsylvania, to businesses in California. At the end of the day, I don't think tariffs are going to pay the bills. I think a continued economic growth in the United States with low taxes is the right recipe to get us back on the right track.
Well, Representative, since you mentioned your own constituents, I want to talk about some of the feedback that you've been getting from them at the likes of town halls. You're obviously historically a popular politician, but the feedback has gotten loud and negative off the back of some of these policies from the administration. To what extent are you willing to push back on any measures from this administration to cut things like Medicare, like Medicaid, that your constituents have voiced concerns about?
Well, I think obviously we have to find the right balance on an issue like Medicaid. I've always believed that we need Medicaid for the vulnerable, for those that are not able-bodied, for the mentally ill or the developmentally disabled. All of those things are very important. But I do think that Medicaid isn't a one-size-fits-all for each state. In Nebraska, we have 3% unemployment. I'm not one bit worried about workforce requirements or verifying that they're out looking for work. I'm also very open-minded on some of the other changes they want to make. I don't like the idea of taking SNAP money away from the states. That would be an $85 million on top of burden to the state taxpayers here in Nebraska. So it's a delicate balance. And I'll tell you what, I may be one of the only representatives to hold town halls, but I find a lot of value in them. And there's no doubt that at times our country's divided. Everybody should have the right to come and talk to their member of Congress and share what they believe the future of the country is. And I see that as part of my job, and that's why I hold those town halls.
And talk to me about this weekend. You're obviously heading to the Berkshire weekend here. What are you anticipating to hear from Warren Buffett when it comes to trade policy?
Well, Warren Buffett is a Nebraska treasure, University of Nebraska graduate. He's built a wonderful business here. I think Warren always tells it like he sees it. There's times I agree with everything he says, and there's times I don't. But here in Nebraska, we are, I flew back from Washington yesterday. The plane was packed. The young man next to me was from India, and he was reading a book on Warren Buffett, and he was watching videos. And I just thought to myself, how fortunate are we in Nebraska to have one of our own be one of the most successful business people in the history of the world. And his favorite place to live is Omaha. He lives in a modest house, and he reminds everybody that hard work and a little bit of opportunity can take anybody anywhere in our great country.
Congressman, thank you so much. Appreciate it.
Thank you. Have a good weekend.
You too. Take a look at Brooks Running. In the first quarter, Brooks Running reached record quarterly revenue with global sales growing 15% year over year and 13% growth in North America. These milestones coming alongside uncertainty in U.S. trade policy and sliding consumer confidence. Dan Sheridan, Brooks Running CEO, joining us live from Nebraska for its parent company, Berkshire Hathaway's annual meeting. I'm also joined by my morning brief co-host, Brad Smith. It's great to speak with you this morning, Dan. Talk to me about the extent to which you are anticipating these tariff policies hitting your business. In January, you told our network that you were already concerned about the headwind, and that was before triple-digit tariffs on China.
Yeah, good morning. Thanks for having us. We're joining you here live from the Berkshire Hathaway shareholder meeting. We just finished a great quarter, up 15% globally, and our demand signals are incredibly strong. But we've got a lot of uncertainty ahead of us with the tariffs, and so we're going to work on it. Like every business, when there's uncertainty, we're leaning into our partners in Asia. We're thinking a lot about the markets we compete in, And obviously price increases are a part of that. So uncertainty ahead, but we feel really good about the category that has been durable in times of economic uncertainty, and we think it will be here too.
We've heard from representatives, Dan, in the past from Brooks Running saying that running is recession resilient, but is it tariff resilient as well, considering how consumers are clearly shifting their own sentiments, knowing that they're going to be potentially paying a lot more for normal things, and that includes running shoes?
Yeah, great question, Brad. I think the way we view this is that, this is a considered purchase. Performance running gear for runners is super important. And so what we've seen over time is it is recession proof. In times of economic uncertainty, we've actually grown every single time. Go back to 2008, even in 2016, 17, and obviously COVID. So we believe the category will hold up. But we know that there's sensitivity to price in our category as well. And so we're paying attention to that. We're being smart in how we think about pricing around the world.
Knowing the arm's length that you have to Warren Buffett and the business, what is he advising the business right now, especially knowing that companies have the difficult decision of trying to figure out, do we absorb the tariffs, or is that something that we pass on to the consumer? And how are you thinking about that? Do you need to pass that cost to the consumer?
Yeah, I mean, I think the beauty of being a Berkshire brand is we always think long term. So even in times like this, we're thinking 3-4 years out. And I think that's important in times of uncertainty. So Warren's sage advice to us over time is focus on your customer, which we're going to do. And so as we look at the landscape and what tariffs are bringing to our business, we'll continue to consider how it impacts our customers, our partners, our retailers around the world. And I think it's super important for us to stay focused on the customer.
Dan, are you raising prices in response to tariffs?
Yeah, we'll have some slight price increases. We're trying not to overreact, right? Because of the uncertainty, we don't know which way the tariffs will go. And so we're trying not to overreact. And the truth is we're looking at the entire supply chain at Brooks to get smart on cost optimization and efficiency. And I think most businesses are going to do that in this time.
And I know you mentioned that you are going to raise prices. How are you thinking about the degree to which you need to raise those, especially as negotiations are ongoing?
Yeah, it's a tricky one, right? I think what we do is we focus on obviously the competition and the market we play in. We're the #1 brand in performance run here in the US. And so we have some pricing power, but we don't want to punish the consumer because of these tariffs. So we have to be pitch perfect in this. And we're looking at prices right now. We think, on average, it'll be probably 2.5% to 3% increases on select styles, not every style. So I think we can navigate this, but obviously there's a lot of uncertainty for us.
Dan, we have to hustle to the finish here, and I know that your sneakers on the ground there at the Berkshire Hathaway meeting. And so as you're kind of thinking about the business right now, has the risk of tariffs changed where you're sourcing materials from and supplies to build out and manufacture shoes? And then just lastly, on the back of that, which shoes is Warren Buffett wearing?
Well, so in terms of the supply chain, look, we're somewhat fortunate because we've moved our supply chain to Vietnam and Indonesia, not immune to the tariffs, obviously, but to some less degree than the China source base. So we've got a really nice, resilient, and agile supply chain right now. However, global trade war could change that. I think Warren's probably wearing the most comfortable shoes in the expo here, and I would assume they're Brooks, but I haven't seen them yet this morning.
Sneakers go well with some suits. I try it. I try to pull it off, Dan.
I love it, Brad.
All right, Dan, thank you so much. Appreciate your time, and also thanks to our own Brad Smith.
Thanks.
We'll have all your markets action ahead. Stick around. You're watching Catalysts. Major U.S. ports are starting to feel the effects of the global trade war. The top countries for U.S. imports by shipping weight are China, Mexico, and Canada. That's according to 2024 data. Overall, the U.S. imported nearly $439 billion worth of goods from China last year. The Port of Los Angeles is the busiest container port in North America and has been the #1 container port in the U.S. since the year 2000. Shipments from China make up about 45% of the business for the port. Now, import volumes are starting to take a hit hit from President Trump's tariffs, down nearly 28% just this week. That's nearly 10% lower than this time last year as companies cut back on orders. And looking ahead to next week, import volumes are expected to be 16% lower compared to this week and down more than 35% year over year. U.S. consumers could start to see the shortages in stores next month due to President Trump's tariffs. Torsten Slog, the chief economist over at Apollo, laying out a timeline showing the economic impact of the trade war, with container ships to U.S. ports coming to a halt in the beginning of May. Trucking demand stopping in late May, leading to empty shelves and eventually causing layoffs and a recession. Joining us now with more, Gene Soroka, Port of Los Angeles executive director, and still with me is Ed Al-Husseini of Columbia Threadneedle. Gene, great to speak with you. You've been at the Port of Los Angeles through past supply chain crises, including, of course, most recently the COVID-19 pandemic. Talk me through how this one compares.
Oh, good morning, Madison. You know, this is where it pretty much begins. A precipitous drop, very fast. 17 canceled sailings next month out of 80 that were scheduled. And as you reported, 35% drop just next week in imports alone. So what we don't know is how quickly the pickup will be, and that all depends on the parties that need to get to the negotiating table.
And I've heard you explain this before, that this is a long game. Retailers put in factory orders as much as 3 months ahead of the vessels that sail here and take about 2 weeks. How much more of a decline are you anticipating?
Well, this is where it's going to get interesting. Retailers are telling me that they have about 5 to 7 weeks of normal inventory remaining.
Yeah.
And we're coming up on spring and summer fashion. Not too far after that will be the back to school season. So we're at a pretty important time. If we reached a deal with China right now, it would take about 2 weeks to get the vessels back into the ports. Think of Qingdao, Shanghai, Xiamen, and then another 2 weeks to steam over to LA. So time is short.
Time is short, but you're talking about the clothes the consumers are going to see in their local retailer by this summer. What does that look like? There are all these headlines, empty shelves coming as soon as the summer. Talk me through what the consumer listening can anticipate.
Yeah, I think spot shortages, fewer selections, and higher prices.
Walk me through what that exactly looks like then, because higher prices on what exactly is going to be missing from shelves? Because people, they're flooding on our inboxes here at Yahoo Finance with questions about whether or not they should start stockpiling stuff.
Right. What came in early were products that sell all year long: furniture, appliances, electronics. If you're out looking for a blue shirt of a particular type and size, you may find 11 purple ones. And the one blue that you're looking at may not be exactly what you wanted to purchase, and the price is likely higher. So spot shortages, popular items moving, and prices being raised.
You know, we just had labor market data this morning showing pretty robust hiring in logistics, and warehousing and so on. When do you expect to see these shortages start to show up in that kind of hiring?
Yeah, Ed, our business is all about scale. And with the volume dropping so much next week, you'll see fewer job opportunities, as we call them. Not mass layoffs, but if a trucker was hauling 4 and 5 containers, next week they probably haul 2 or 3 a day. The longshore member who's been getting overtime and working back-to-back shifts will likely work less than a traditional work week. So we'll start to see those work efforts go down.
Yeah, I feel like in many ways you have the most interesting job in America right now, given the focus on the supply chain. If you were briefing the White House at the moment, what would be kind of the top point you would make for them?
Rules-based trade is paramount to us, protecting American jobs and American interests. But knowing that 90% of world trade moves on water and 70% of our economy is consumer purchasing, we've got to find a sweet spot here. And other countries want to protect their interest as well. That's a good place to start. What are the must-haves in these negotiations? And then let's get back down to the point where American consumers are not fretting over even more inflationary data coming our way.
But this administration would say that over a longer time horizon, all of this is going to be good for all of the things that you just mentioned, for consumers, for the economy, for the labor market. What specifically would you want to correct there?
Well, I'm hoping that we do have some good come out of this, and it is quite painful right now for a lot of people. Folks are very concerned about their jobs in and around the docks in Southern California. About 1 million people have jobs related to the port in the 5-county area. But what I would say is this, that even on today's discussion, if we said we're going to open up a factory, it likely would take about 5 years. When it opens its doors, it more than likely is automated with fewer jobs than some had anticipated. So again, let's focus on the must-haves and work the other areas through. We want to produce more American jobs, and one of them is in the agriculture sector, who have been getting hit extremely hard by the retaliatory tariffs.
As executive director of the Port of LA, how are you thinking about any decrease in hours for your workers to come or any potential layoffs you might have to do?
Right. I am thinking right now that we're not going to have layoffs, but here's what we're looking at. A decade of very strong financial policy. We've been able to pay down our debt, raise money, sell at AAA pricing, and that commitment will take us through this cycle. We average about 3,500 construction jobs in and around the docks every day. Our longshore members can get to the work of preventative maintenance and getting all that equipment ready for when that surge does happen after some of these framework deals are reached. So we've got work that we can do through this period of time to keep folks on the job.
So last question. We've focused a lot on imports and obviously the impact on the consumer, the impact on businesses that are depending on CapEx. What about the export sector? What trends are you seeing in terms of U.S. exports to the rest of the world?
Yeah, as I mentioned, on the agriculture side, we only consume about 1/3 of what we grow here in the United States. In California, the Central Valley is really our bread basket. Walnut handlers, almond growers, wine and spirits folks, they're getting hit particularly hard right now. We've got to get that back in motion. And again, as part of these negotiations, that ag farmer, rancher, grower has to be up front. Then there's an opportunity with a large middle class in China, with one that's even bigger than our entire population in India. We've got an opportunity to sell American goods in different ways than we have before.
30 seconds, Gene. Do you think, based on what you're seeing, that we're heading to a recession?
We're halfway there based on the GDP decline we just saw this week.
Gene, thank you so much. It's always amazing to get your insights and appreciate you making time for us while you're on the East Coast as well. Really appreciate it. Thank you. The trade war's full impact on the economy does remain to be seen, but soft data is showing a worried consumer. Hard data still showing some signs of resilience. So what's the read from small businesses on consumer spending and how are tariffs impacting them? Joining us now on this, Ashley Neal is the owner of Veracruz Margarita Bar here in Brooklyn, New York. Ashley, great to speak with you. I love talking to small business owners because you can tell us directly what you are seeing from consumers. Talk to me about your read on the economy based on what you are seeing. What is the Veracruz economy looking like?
Well, first off, thank you for having me. It's a great opportunity to be here. I've never had more people ask me if it's happy hour at 9 o'clock at night. So it's like I'm trying to combat that. They're taking advantage of drink specials too more than ever. And I'm trying to make them happy by lowering my prices. So I used to have $14 margaritas. I dropped it down to $10 just to get increased volume and get more sales out of it too.
How do you think about a decision like that? How do you think about the cost-benefit analysis of dropping the margarita to $10 when you're going to have to sell more to make up for that?
Well, look, post-pandemic, people are stuck at home. I'm trying to get them out of their apartments and going to drink in a bar. Right. And also, there's plenty of competition around 2 new businesses opening up, so I'm trying to, be relatable with them, with the customers. So get them out of the apartments, come drink, and be more social, too.
All right. And Ed, do you have a question?
Being more social, I think, is something we can all use. Give me a sense, when you were thinking about your inventory, are you stocking up? Have you front-loaded demand? What does that look like?
I ordered more in bulk just so I can get a better deal on the prices, and then I can just drop the prices and focus on the demand of the customers too. So I also did lower the shop prices to $5 just to get people into the bar, and a lot of bars are also doing like game nights, get people to be more communal with each other too. So that's what I'm trying to do, get people in. I'm doing karaoke, bingo nights. And
I heard you mention the supply chain element. I wonder about your relationships with suppliers. I know that you are the owner of this business. It's a family business. To what extent are you able to leverage those relationships to maybe negotiate deals on any of the shipments of alcohol that you're getting in spite of the tariffs that are implementing higher prices on a lot of those items?
Well, I'm talking more of the reps too, getting them into the bar to spend more money too. So it gets me more money into the business too, and they can talk about their products to my customers too. So I'm working closer with the brands also. So.
Got it. All right, we got to leave it there, Ashley. Thank you so much. Really appreciate your time. Ed, I want to turn to you because One of the things I love about having guest hosts is that we get to talk for an entire hour off camera, and I get some of my best insights during those conversations. And over the course of this hour, you have highlighted to me some of the challenges with the current economic data that we have. How good of a read do we actually have on the state of this economy with the hard data that we have at our
Yeah, I mean, it's kind of incredible to me that we have an exceptionally broad array of high-frequency soft data, sentiment data, credit card transaction data, all sorts of data that give us a sense of what consumers and businesses are doing. And yet when we aggregate them up to what the economy is doing in the big ticket numbers, growth, employment, inflation, our ability to forecast those variables has not really improved in any meaningful way. Yeah. So pour one out for the Fed. It's a difficult situation. And again, from a policymaker's perspective, especially in terms of monetary policy, the fact that you have the luxury to now wait with the data coming in pretty good is my key takeaway.
So where do you stand on the read of the economy? Like, is the Fed behind? Are we heading for a slowdown? What are you thinking?
Well, I think, again, a lot of what we're seeing today is a legacy of the growth story we've had over the course of the past several years. Yeah. Some of it is fiscal stimulus, the robustness in the consumer demand story coming out of COVID, behavior change coming out of COVID. All of those things have supported, I think, a really good story coming into 2025. We're peeling away those layers, in particular when you look at consumers in the bottom 50% of the income and wealth distribution. Yeah. More distress there. We're definitely seeing that in terms of auto debt, credit card debt. They'll be under more stress with student loans coming online. And so some definitely early signs of stress there. But then you take a step back, and in aggregate, corporate balance sheets are still quite good. Household balance sheets are still quite good. So I think we're looking at an organic slowdown right now. The question in terms of whether the tariff shock will persist, obviously, is still with us, but we haven't fully worn out those buffers. So I think the baseline has got to be an economy that slows down, perhaps meaningfully, but the recession risks are still, I would say, maybe about 1 in 3.
All right, Ed. I guess we'll take those odds, and we have other people saying there's a 90% chance, 1 in 3, better than 90. Thank you so much for joining us. Thank you for giving us great insights throughout the hour. Ed Al-Husseini of Columbia Threadneedle, really appreciate it.
Thank you.
Let's get you a check on the markets before we head to break here. Taking a look at the major averages, you've still got gains across the board off the back of that beat on the labor market print to the upside. You've got your S&P 500 up about 1.2%. Your tech-heavy NASDAQ also up about 1.3% here. Taking a look at the bond market, let's see if we still have that curve steepener coming online here. You've got your 10-year yield up about 6 basis points at 4.29. Your 30-year up about 4 basis points as well. Coming up here, we've got Wealth. It's dedicated to all of your personal finance needs. Brad Smith is going to have you for the next hour, so stay tuned for more.